Hi everyone. So in today's session, we will discuss how managers should read financial statements. So if you are a manager or an aspiring manager who wants to understand the financial health of the business that they are operating, then this video is for you. So without any further delay, let's get started. So before we start with our discussion, I have a request. If you really want to master financial statements, please do the exercise that is given at the end of each section in the video. Also, if you're liking this video, please hit the like button so that more people come to know about it. And don't forget to subscribe for more such interesting content. Now let's get started. So whenever a manager sits down to review financial statements, there are certain things that they should keep in mind. 1. They should know exactly what questions they need to answer by looking into financial statements. 2. Once they know the questions that they need to answer, they should know exactly where in the financial statement those answers lie. So keeping these 2 points in mind, let's look at the financial statements and see how managers should read it. So for this purpose, we will be using the income statement, balance sheet, and cash flow statement. These 3 financial statements are also known as the primary financial statements. In addition to these statements, we also have the statement of changes in equity and the notes to financial statements. Though these statements are very important, but for the purpose of this video, we will focus on understanding how to read the primary financial statements. So first, we will start with the income statement. The income statement is a summary of the revenues and expenses incurred during a period and ends with the net profit or loss for that period. So what does it mean? It means that this statement shows all the revenues earned during a period and all the expenses incurred to earn that revenue. For example, let us say I am running a restaurant and I am earning money from the customers who dine in at my restaurant. This earning will be recorded on the top of the income statement. In addition to this, I will also be incurring expenses such as cost of food, salaries to my employees, rent of the restaurant, and so on. All these expenses will be listed below the revenues. After deducting all the expenses from the revenues, I will arrive at the net profit. If the net profit turns out to be a negative number, then I will be recording it as a net loss. So in this way, an income statement summarizes all the revenues and expenses and shows the net profit or loss for a period. Now coming to the question that how should a manager read an income statement? So while reading an income statement, a manager should be able to answer the following questions. Question 1. What are the different products or services contributing to the revenue? Question 2. How much profit or loss was made on each product or service? Question 3. What are the different expenses involved in earning these revenues? And question number 4. How does the current period's performance compare with the past periods? So to find these answers, let's look at the components of the income statement. First component of an income statement is revenues. As discussed earlier, revenues are the money earned by selling products or services to customers. While analyzing the revenues, a manager needs to ask a lot of questions to understand the business better. Question 1. Did the company increase or decrease its prices during the period? Question 2. Was there any change in the volume of products or services sold? Question 3. Did the company earn any one-time revenues during the period? Question 4. Has the company adopted any new accounting policies related to revenues? And question 5. How does the company's revenue compare with its competitors? By answering all these questions, a manager will get a better idea of whether the revenues are genuinely increasing or decreasing. Once we are done with the analysis of revenues, let's move on to the next component of an income statement, which is cost of sales. Cost of sales, also known as the cost of goods sold, is the direct cost of producing the products or services sold by the company. In other words, it is the cost directly associated with making the products or delivering the services sold. So here again, a manager needs to ask a lot of questions to understand the business better. Question 1. Did the company change the prices of the products? Question 2. Was there any change in the volume of products sold? Question 3. Did the company use any new method of production? Question 4. Did the company use any new source of raw material? And question 5. How did the company's cost of sales compare with its competitors? By answering all these questions, a manager will get a better idea of whether the cost of sales are genuinely increasing or decreasing. After cost of sales, we have gross profit. Gross profit is calculated by deducting the cost of sales from the revenues. So if we look at the formula, gross profit equals revenues minus cost of sales. So when a manager looks into the value of gross profit, He should also look at the components that affect it, that is the revenues and the cost of sales. So if the gross profit is increasing, then a manager should analyze whether it is due to increase in revenues or due to decrease in cost of sales or due to both. Similarly, if the gross profit is decreasing, then also a manager should analyze whether it is due to decrease in revenues or due to increase in cost of sales or due to both. After gross profit, we have operating income. Operating income is the profit a company makes from its normal day-to-day operations. To calculate operating income, we deduct all the operating expenses from the gross profit. Operating expenses are the expenses incurred to run the business. Examples include administrative expenses, selling expenses, distribution expenses, research and development expenses, etc. So when a manager analyzes the operating income, he should look at the components that affect it, that is the gross profit and the operating expenses. So if the operating income is increasing, then a manager should analyze whether it is due to increase in gross profit or due to decrease in operating expenses or due to both. Similarly, if the operating income is decreasing, then also a manager should analyze whether it is due to decrease in gross profit or due to increase in operating expenses or due to both. Once we are done with the operating income, we have the net profit. Net profit is the profit after deducting all the expenses and taxes. To calculate the net profit, we deduct all the non-operating expenses and income tax from the operating income. So when a manager analyzes the net profit, he should look at the components that affect it, that is the operating income and the non-operating expenses. So if the net profit is increasing, then a manager should analyze whether it is due to increase in operating income or due to decrease in non-operating expenses or due to both. Similarly, if the net profit is decreasing, then also a manager should analyze whether it is due to decrease in operating income or due to increase in non-operating expenses or due to both. Now that we have understood how to read an income statement, let's move on to the next financial statement. That is the balance sheet. The balance sheet is a statement of the company's financial position at a specific point in time. It lists the company's assets, liabilities, and shareholders' equity at a specific date. So now the question is, what does it mean? It means that unlike the income statement, which covers a period of time, the balance sheet covers a point of time. It is like a photograph of the company's financial position at a specific date. The basic accounting equation that is reflected in the balance sheet is assets equals liabilities plus shareholders' equity. Assets are the resources owned by the company. Examples include cash, accounts receivable, inventory, property, plant and equipment, etc. Liabilities are the company's obligations or debts. Examples include accounts payable, loans, bonds payable, etc. Shareholders' equity represents the owner's stake in the company. It is the residual interest in the assets of the company after deducting all its liabilities. When a manager reads the balance sheet, he should be able to answer the following questions. Question no. 1. What are the major assets of the company? Question no. 2. What is the company's debt level? Question no. 3. How much of the company's financing comes from equity? Question no. 4. What are the major current and non-current liabilities of the company? Question no. 5. Is the company generating sufficient cash from its operations? Question no. 6. How liquid is the company? And question number 7. How does the company's financial position compare with its competitors? So to find these answers, let's look at the components of the balance sheet. First, we will start with current assets. Current assets are the assets that are expected to be converted into cash or used up within 1 year or the operating cycle of the business, whichever is longer. Examples include cash, accounts receivable, inventory, etc. When a manager analyzes the current assets, he should look at the company's ability to convert these assets into cash. He should also analyze whether the company is holding too much or too little inventory. After current assets, we have non-current assets. Non-current assets are assets that are not expected to be converted into cash or used up within 1 year or the operating cycle of the business, whichever is longer. Examples include property, plant, and equipment. When a manager analyzes the non-current assets, he should look at the company's investment in these assets and their impact on the company's profitability. Now moving on to current liabilities. Current liabilities are the company's obligations that are due within 1 year or the operating cycle of the business, whichever is longer. Examples include accounts payable, short-term loans, etc. When a manager analyzes the current liabilities, he should look at the company's ability to pay off these obligations. He should also analyze whether the company is taking on too much or too little debt. After current liabilities, we have non-current liabilities. Non-current liabilities are the company's obligations that are due beyond 1 year or the operating cycle of the business, whichever is longer. Examples include long-term loans, bonds payable, etc. When a manager analyzes the non-current liabilities, he should look at the terms of these obligations and their impact on the company's financial flexibility. Moving on to shareholders' equity. Shareholders' equity represents the owner's stake in the company. It is the residual interest in the assets of the company after deducting all its liabilities. When a manager analyzes the shareholders' equity, he should look at the changes in the equity over time and the reasons for those changes. Now that we have understood how to read the balance sheet, let's move on to the last financial statement. That is the cash flow statement. The cash flow statement is a statement of the cash inflows and outflows of a company during a period. It categorizes all the cash transactions of the company into 3 activities. That is operating activities, investing activities, and financing activities. When a manager reads the cash flow statement, he should be able to answer the following questions. Question No. 1. Is the company generating sufficient cash from its operations? Question No. 2. How is the company financing its growth? Question No. 3. How much cash is being used in investing activities? And question No. 4. What are the major sources and uses of cash? So to find these answers, let's look at the components of the cash flow statement. First, we will start with operating activities. Operating activities are the cash flows related to the company's core business operations. So examples include cash received from customers, cash paid to suppliers, cash paid to employees, etc. When a manager analyzes the operating activities, he should look at the company's ability to generate cash from its operations. After operating activities, we have investing activities. Investing activities are the cash flows related to the company's investments. Examples include cash received from selling investments, cash paid to acquire property, plant and equipment, etc. When a manager analyzes the investing activities, he should look at the company's investment strategy and its impact on the company's cash flows. Now moving on to financing activities. Financing activities are the cash flows related to the company's financing. Examples include cash received from issuing debt, cash paid to repay debt, cash received from issuing equity, etc. When a manager analyzes the financing activities, he should look at how the company is financing its growth and the impact of financing decisions on the company's cash flows. We have come to the end of this video. I hope you found this video useful. If you really want to master financial statements, please do the exercise that is given at the end of each section in the video. Also, if you're liking this video, please hit the like button so that more people come to know about it. And don't forget to subscribe for more such interesting content. Thank you and best of luck for your future endeavors.